All right, market heroes, here we go. Put debit spreads. So we've already touched on put credit spreads, which involves selling a put and buying a put further out of the money as a bullish strategy. Now, a put debit spread is a bearish strategy that we're going to talk about. Now, one of the things about bearish strategies are they're best employed when implied volatility is low, right? These are not the easiest strategies to really make a lot of money on. However, we dug really deep, and actually this took me forever, but we've dug really deep to figure out how to actually turn this strategy, which across the board is really not a very profitable strategy, into a profitable one. The cool thing here, again, obviously, higher return on capital potential, and at the same time, you can only lose what you pay here, right? This is because we're paying a debit here. So what is a put debit spread, right? So a put debit spread is when we buy a put and sell a put further out of the money to reduce our cost basis and cap our upside, right? So again, it's a bearish strategy where we profit from an increase in implied volatility or a decrease in prices, right? So the reason we profit here from an increase in implied volatility is because the put we buy is going to be more expensive than the call we sell that's further out of the money. And if implied volatility goes up, the price of both puts will go up. However, the price of the put that we're buying is already more expensive, thus it's going to go up more and quicker than the put that we're selling that's further out of the money. So that's how we're going to end up making money. And I'll show you guys how to do this here in a second. So let's jump right into the studies, right? This is what everyone wants to know. How the hell do we make money from this? You know, stocks are going to be up and implied volatility is going to be low. So we are going to need strategies that not only benefit from a reduction in prices, but also at the same time an increase in implied volatility. When prices go down, implied volatility usually goes higher. So how the hell can we do this? So what we did is, again, 2003 to present, depending on when you're watching this, that's about 10 and a half years, 14 and a half years. Every day in SPY, we bought the 60 delta put and sold the 40 delta put, right? That is a put debit spread. So let's see what that looks like. So I'm in SPY, and I'm going to, again, just like everything else, the monthly expiration cycle that's closest to 50 days from expiring. And I'm going to go ahead and try to find the 60 put, and we're going to go ahead and buy it. So let's see, 60 put, the closest one to that is a 249 strike right here, right? So we're paying, let's call it, 261 for that, right? So I want to buy the 60 delta put, and I want to go ahead and sell the 40 delta put, right? As you can see, that's a vertical spread that we're paying. So we pay $1.93 for this specific trade. So we're paying $1.93. The most money we can make is $307, right? So that's the most money we can make on this. So it's it's like a risk one to make about 1.5 type deal, right? That's the trade in itself, right? So that is a put debit spread. Again, a debit because we're paying this. So as soon as this trade happens, we will give this money to whoever's taking the other side of this trade, right? So we make money on this strategy. We make money on this specific strategy if the value of the 249 put being long subtracted from the value of the 244 put is greater than $1.93 at expiration. But so the way to think about that is, actually I'll show you right here, our break evens on this are 247.07, right? So anything below 247.07, how do I get rid of this? Anything below 247.07, we make money. You might say, that's pretty interesting, Stephen. And the reason it's interesting is because the current price, actually let me pull this up right now, the current price of SPY is already below that, right? So we're already profitable on that. But again, these things are pretty perfectly priced. There's no edge in doing this. In fact, you'll see how difficult this strategy can be. But again, I'll preview this for you. We did find a way to make this quite a profitable strategy. So again, that is a put debit spread. So we did that every single day, no matter what. Now again, this is a bearish strategy, and we're doing it in a bull market. Now, you've seen other strategies like calendar spreads that were bearish strategies done in bull markets that we figured out how to make them profitable. Short calls, right? Short calls, which are, again, a bearish strategy in a bull market, which are profitable. Short credit spreads, right? So short call credit spreads, which, again, are a bearish directional bet in a bullish market, right? This is no different. So we can't expect these results to be really great off the bat. But again, as you know, we have a couple of ways to improve on the normal type of results we get. So let's see what happens here. So again, we did all these trades with no expiration and we just held them until management, right? So if you do it every day, you lose about 31 bucks every single trade, and you're only right about 39% of the time, right? So you're losing an average of 62 cents a day. Right, so this trade off the bat is not a trade that we should ever do, which again is buying the 60 delta put, selling the 40 delta put, and letting it expire. This is no good. But again, we have a couple tricks up our sleeve to see if we can turn this into a profitable strategy, right? So we take it a step further now, right? So we do the same time frame in SPY every single day. This time we do all occurrences, which you just saw, hold into expiration, and let's see what happens if we manage to trade at 50% of max profit, right? So as you can see on this specific example, the max profit is 307, right? So when we were let's see, 307 divided by 2, when we are a $153 winner on this trade, that's when we would go ahead and pull it off, right? So if we're paying $1.93, sorry, I just messed up on the math, everyone. But anyway, so we're paying $1.93, right? So you guys can see this here. We're paying $1.93, and we know that the max profit is 307, right? So 50% of that is going to be 50% of the 307 is going to be 153 or 153. So when we have a 153 profit on this, we want to go ahead and sell it, right? That would be the 50% management on this put debit spread, right? So what is the price that we're looking for there? Well, 193 plus the actual 152. So again, if the value of this spread ever got to 346, we would go ahead and sell it, right? So that would be an example of managing a put debit spread at 50% of profit, right? Now again, that works with selling options. It works with buying options, as you guys saw with credit spreads. With calendar spreads. But let's see how it works here. Right, so it looks like we do a little bit better, about 50% better to be exact, right? It doesn't make it a profitable strategy. However, we've taken our winners from 39% to 48%, our P&L per trade from $31 to about 15 bucks. We're in the trade a little bit less, right? And we make we lose about half the amount that we lose when we just put on the trade and hold it to expiration, right? Still, it's a no-go. Still, this is not a profitable strategy that anyone should be considering doing. However, we do have some more tricks up our sleeve, like measuring volatility. If you remember, the way we make money on debit spreads, and specifically put debit spreads, is not only a reduction in prices, but also an increase in implied volatility, right? The reason we make money on an increase in implied volatility is because the put that we're long is deeper in the money. Thus it's a higher price than the put that we're selling that's further out of the money, right? And if implied volatility increases, both of those options will increase. However, the put that we're long that's deeper in the money that has a higher delta, its value will increase more than the put that we're short, right? So that's how we profit from an increase in implied volatility for put debit spreads, right? So now we want to do it every single day, holding to expiration. We want to do it every single day and managing it at 50% of max profit. And then we want to bracket both of those into periods of low volatility, because again, this strategy makes money. We'll find out if it's effective. This strategy makes money with an increase in implied volatility. So let's see the results. So we do improve doing this in periods of low volatility. There's no question about that, right? So we take our P&L per day of negative 62 cents to negative 29 cents when we're just doing put debit spreads every single day, holding till expiration, right? At the same time, we take our losses from losing 36 cents a day to only losing 17 cents a day when we manage it at 50% and then break it up by periods of low implied volatility. So the truth is, this is not that great. I mean, we've kind of exhausted a lot of what we can exhaust, right? We can take strategies and do them every day, and a lot of time they work, right? But again, this is not selling options, so we don't really have a huge edge in here like we do in selling options. So remember, what we tried was doing it every day. That didn't work. What we tried was managing it at 50%. That doesn't work. What we try is doing it in periods of low volatility. That doesn't work. So I'm not giving up on this one, because I want to every single strategy that we do, I want to show you exactly the perfect time to do it to make you the most amount of money, right? So let's take it a step further. I'm gonna start taking it a step further, and this one should be really exciting for all you market heroes out there. So what we're gonna do is this. We did a study Again, same time frame, 2003 to present, which is 14 and a half plus years, depending on whenever you're watching this, right? Every single Monday, we bought a put debit spread, again, which is buying the 60 delta put, selling the 40 delta put to create a vertical spread, right? If the following conditions were met, right? If SPY was up the week before, and if implied volatility was below its average, right? So now we're really trying to take what we did in the last section, right, where we were looking to buy this spread in periods of low volatility, which was our best outcome. It still wasn't profitable, but it was our best outcome, as you can see on the right side of the column. Now we want to do it when we're buying this or we're selling into an extreme, right? We're putting on a bearish position after a pretty large move in SPY. So if SPY was up for 1% the week before, we went ahead and put the strategy on. Now let's see how we did. Right? So interesting. Now we've kind of turned it into a profitable strategy, which is really, really cool, right? So we're right 53% of the time. We average about 22 cents per day. And since we're managing at 50%, we are in the trade for only 31 days on average. So this is really, really great. Because again, we've come a pretty long way. We've come from doing this every day, no matter what, losing money. Right? Then we took it all the way to managing at 50%, still losing money at a rate of 36 cents a day. Then we said, let's just do it in periods of low implied volatility. We're still down 17 cents a day. But now we're doing this into an extreme, right? We're selling into an extreme here. Now we're doing this, and it looks like we've turned it into a profitable trade. However, 22 cents a day, there are a lot better strategies out there than doing this. In fact, if this is as good as it gets, I would never even have shown you this lesson. Again, you guys have seen calendar spreads, you've seen short calls, you've seen credit spreads that are a lot better for a negative directional bias in terms of P&L per day. 22 cents is not great. So what I want to do is I want to take it even a step further, right? I want to take it even a step further, right? So now what I want to do is I want to do it when SPY was up for 1% in the prior week, right? So we already went through that, and we've seen that it kind of takes a loser and makes it into a winner. Right? Instead of just implied volatility being below average, we want implied volatility to be below 5%. Right? So that is at the very wide end of the spectrum in terms of low volatility, right? And the reason for that is because volatility, as you guys know, is mean reverting, right? It reverts a lot quicker to the mean when it's above than it does when it's below. However, 5% is really on the very low end of the range in terms of implied volatility, right? So we're going to do the same thing as last time, right? If SPY was up a week before, and if implied volatility on SPY was in its bottom 5%, then we were going to go ahead and put on a 40-60 delta debit spread, and we're going to look to manage it at 50% of max profits. So let's see what that looks like. Now we're talking. All right, now this is an actual strategy that we can do, right? Because this rivals, again, calendar spreads, short call spreads, naked calls, vertical spreads, all that stuff, short vertical spreads. So this rivals it. So now we're right 61% of the time, right? For an average of 23 bucks per trade and about 82 cents per day, right? And if you remember, $23 is like not the biggest thing in the world. However, this trade only costs us $1.93. So let's see, 23.93, right? So that's about a 11% return on capital in a 28-day period, just based off the numbers right now. So while this is not the greatest trade ever, we've obviously come a very long way, right? We started losing 62 cents a day. Now we figured out after trial and error, again, if the market is up 1% the week before and implied volatility is below its 5% average, right? It was below 5%. And we managed it 50%. Now we're making 82 cents a day and making 23 bucks when it's costing us how much? It's costing us $193. Again, is like an 11% return on capital. So again, pretty big return on capital. So when stocks are up 1% the week before and implied volatility is below 5%, not 50%, 5%, you can go ahead and put on a put debit spread where we're purchasing a 60 delta put and we're selling a 40 delta put, right? And make sure to manage that at 50% of max profit. That's when you can go ahead and execute these strategies. These are a very profitable strategy, even into a hardcore bull market. I'll see you on the next video.